Get another check on Amazon as well, because those shares are lower, but off the lows as investors continue to digest the numbers. And with Amazon, there certainly are quite a few. We're down about 3.5% right now. Joining us is D.A. Davidson's head of tech research, Gil Luria, and Wedbush managing director, Scott Devitt. Great to have you both here. Just in terms of some of these metrics that matter for Amazon, I mean, we had operating margin of 11.3%. That was better than expected. It looks like North America revenue and operating income both better than expected. AWS basically in line. Online stores also better than expected at $75.6 billion. Physical stores better than expected. Little light on advertising services here. And then, of course, we know the guide is softer than the street was anticipating. So, Gil, I'll kick it off with you because overall this report seems pretty solid. Is it really the guide that's pressuring the stock right now?
Yeah, that's really all it is. And we'll get more granularity on the call. Clearly, Forex was a bigger impact than we thought. Leap year we should have had in the numbers, but it also a factor. But if you were to focus on the two key numbers here, AWS growing 19%, which is the same as last quarter, means Amazon has regained the leadership in AI. Both Microsoft Azure and Google Cloud decelerated in the quarter, in fact, significantly decelerated in Google's case, while Amazon has been able to maintain the same growth while expanding margins. And then on the retail side, 8% margins in North America is unprecedented. It's by far the highest they've ever had, and it means they've taken that retail business to another level in terms of profitability. So those things are great. We'll have to see what they say about the guide.
Scott, how much is CapEx going to matter here, too, especially as this company does continue to maintain these margins, at least for now, but we know everybody among the hyperscalers are spending quite a bit of money to build out their infrastructure, despite all the concerns around the DeepSeek shakeout a couple weeks ago.
Right. It seems like that was years ago now. But the CapEx, if you take the $26 billion that was spent in the fourth quarter, and annualize that for 2025, they're on a run rate to spend about $100 billion worth of CapEx in 2025. Did I lose you?
We've got you.
Okay. So there, one of the other thing that I would add to what Gil said is, that 26 number annualized is 100 billion. And so getting them to talk a bit about that and what the run rate is for that for 2025 is important. But I would caveat, that with, they also guided to the 1Q number. They've now beaten the high end of their operating income guidance for 8 consecutive quarters. And so the high end of the op-inc guidance, I think, is more relevant than that revenue dynamic, which is affected by the 400 basis point move in the currency and the leap year. And the op-inc guide was actually quite strong.
Gil, I do want to get your thoughts on spending here, because obviously AI is a big chunk of it. But I just think back to last week when UPS's CEO joined me here on CNBC to talk about the fact that they're going to start paring back their deliveries of Amazon packages over the next, call it, 2 years. They spend a lot on transportation and supply chain and other aspects of infrastructure, too. We know they've tightened their belts there. Is that dynamic going to change when you think about a partner like UPS pulling back and also things like tariffs on goods coming in from China?
Yeah, so a few years ago, UPS and FedEx made a huge mistake by not giving Amazon the price concessions they should have. So Amazon has built its own capabilities that are now far exceed those of UPS and FedEx, and they continue to invest there. So let's not forget, when we're talking about Amazon CapEx, we're also talking about fulfillment centers and distribution and the retail side. And part of the reason they can spend so much on data centers is that they can ratchet those down. So even if Scott's right and they continue at this CapEx run rate of $100 billion, that's still a lot less growth than Google and Microsoft have had to put in. So Amazon is a bigger business. They are used to spending a lot of CapEx, so they can absorb that spend better without having as much of a drag on margins as the other two will have. So Amazon has the capacity to invest 100, even maybe 110, 120 in CapEx with a lower drag on margins than those other two. And they're winning in AI, again, because they're adding more AI business now than their competitors. That wasn't the case a year ago, and now it's clearly the case.